everyone. I'm going to talk about the Polar Capital Global Financial Trust this evening. Let me just move that out of the way. So, a team of 5 of us at Polar look at the financial sector. It's the second largest in global equity markets. And we run 3 different strategies, income and growth, and growth. Today, I'm talking about the middle one, so the investment trust. We launched it in 2013 as a low-risk way of playing the recovery in global financials with an income and growth mandate yielding 3% at launch. We show performance since launch and since the corporate action that we undertook for the trust last year. So the trust was launched originally with a fixed life of 7 years to May last year in the middle of the pandemic. And thankfully, we reconstructed it to give it an indefinite life, subject to regular tender offers at NAV minus costs every 5 years. So the next one in June 2025. But I can talk about that a little bit later. So performance has been good. We shared against our benchmark, global, the MSCI equity financials, against the Lipper open-ended peer group, and we shared against a selection of UK financials. And I suppose this is one of the key arguments is when you look at financials and particularly banks, is don't necessarily look at them through the performance of UK banks over the last 10 years. There's huge opportunities globally, and that's what we look to try and take advantage of with this trust. For regulation reasons, we show performance here discrete as well. And obviously, you've got to be aware for those who don't look at investment trusts regularly, they can trade at a discount or a premium to their net asset value. So it does provide some volatility, but also an opportunity as well. So reasons to own financials at this point. Despite the bounce in markets, we still see them as cheap, particularly relative to wider global equity markets and other sectors. I think it goes without saying they're a beneficiary of rotation into value and obviously the reopening trade. And because last year wasn't a balance sheet event for the sector, then you're benefiting from that cyclical recovery in their earnings and then growth thereafter. 2 particular catalysts are very interesting at this point. One is as regulators remove remaining restrictions, you're going to see an acceleration of capital return to shareholders, so through buybacks and dividends. The elephant in the room, obviously around inflation, bond yields and interest rates. I'll talk about that a bit later. And longer term, there's structural growth drivers as well. So last year, banks underperformed global equity markets by more than they did in the GFC, the banking crisis of 2008. To us, that was completely illogical. 12 years ago, banks were failing. Last year, they weren't. Now, you'd expect banks and other financials to underperform. They're cyclical businesses, therefore sensitive to the economic cycle. But we thought this degree of underperformance was unwarranted. Now, the reason they obviously fell quite sharply is concerns that banks and insurance would see significant losses around COVID. Now, in the case of banks, you saw a huge jump in borrowers taking payment holidays or loan deferrals. We show this on the right for a selection of banks. And yet 95% plus of those borrowers have gone back to paying interest and principal as normal. On the left, we show the trend of what we call non-performing loans or bad debts. As you can see, the increase is a fraction of what we saw 10 plus years ago during the GFC. So banks remain remarkably resilient, notwithstanding the impact of COVID has on certain sectors leisure, retail, and so forth. Another significant change into this downturn was changes in accounting regulations around the recognition of loan losses. So this is IFRS 9 and CECL in the US. So previously, banks would only take provisions when someone defaulted on a loan. In this downturn, banks had to input models for GDP, unemployment, real estate prices to set their loan loss reserves. So back in the middle of last year, banks were assuming in the US a fall of GDP of 9%, unemployment hitting 10%, fall in real estate prices. And as a result, they took significant reserves, provisions for that eventuality. As we now know, GDP only fell about 3.5% in the US last year. Consequently, banks, as we show, particularly US here, as we show, have significantly over-provisioned for the downturn. JP Morgan has put a number out in the public domain of having $7 billion of excess reserves for their base case economic forecast. Consequently, going into this year, into 2022, you're seeing a sharp recovery in earnings of the financial sector, and particularly banks, followed by insurance. And that's obviously driving a rally in the share prices of the sector. But what this estimates that analysts have currently don't assume is they don't assume a complete normalization of loan losses for the banking sector over this forecast period. They don't assume a recovery in loan growth by any means. And critically, they don't assume interest rates are going to rise over the next couple of years, which will have a material impact on bank earnings. One reason, obviously, not to own the sector in the last 5 or so years is the headwind of low or negative interest rates. That's squeezed the margins that banks can make out of loan books and hit their profitability and their share prices. For us, this downturn has the big difference is the size of the government stimulus has led to what we call broad money growth on the right-hand chart, hitting levels not seen since World War II. Consequently, with obviously supply side issues, pent-up demand, etc., the inflation genie has come out of the bottle. Inflation expectations have risen, bond yields have risen against that, the yield curve has steepened, and that's very good news for the sector. Now, we remain open-minded about whether some of the inflation impact is transitory, but certainly in the short run, higher inflation or higher interest rate expectations is good for the sector, and I'll explain why in a couple of slides. On the left hand, we show here the correlation to government bond yields. And you can see financials and particularly banks are very positively correlated. So the higher the bond yields go, the better bank share prices do. On the right, what we try and show is some of the diversification benefits owning the sector at this point in the cycle. So tech shares, other fast-growing sectors have benefited from the low interest rate environment, and financials, particularly banks, provide you some diversification benefits, from those sectors at this current point in the cycle. So what happens when interest rates rise? So what we've highlighted here is the impact from a 1% increase in US interest rates over the course of a year. That, all things being equal, in that first year leads to US banks' earnings rising by about 13%. And as it takes time for loans to reprice and feed through the balance sheet into the P&L, that increases to 20% in year 2. If you're looking at European or UK or Japanese banks, then the sensitivity is even higher for many of those banks because their profitability is lower. So any incremental, good news about margins with increased interest rates feeds through to the bottom line. So you've got material upside, as and when interest rates do rise. What we're trying to show here is banks' balance sheets, much stronger than they were 12 years ago during the GFC. So banks are being forced by regulators to raise significant amounts of capital or retain earnings to grow their balance sheets. And consequently, they're in a much stronger position now than they have been in the case of the US, probably going back to the 1930s. On the right, we show a chart of the number of banks that have gone bust in the US, for the last 40 odd years. And you need a magnifying glass to see how many banks went bust in the US last year. I mean, almost none. And that shows you, the resilience of the sector since the changes put in place post the global financial crisis. Consequently, this leads on to capital return. Regulators in the UK and Europe banned all buybacks and dividends last year, and only slightly lightened the restrictions at the beginning of this year. Consequently, as those restrictions are lifted, you're going to see a significant acceleration in buybacks and dividends from European banks, on average about 9%. And we see that a high level of dividend and buyback being sustainable in future years. In the case of Swiss, US, and other global regulators, restrictions were very limited. Banks were allowed to continue to pay dividends. And come June, all restrictions in the US are being lifted, And again, we think we'll see an acceleration in buybacks and dividends over the course of the year. So it's a catalyst for people to re-engage with the sector. UK banks, just to touch on them briefly, we think they'll benefit from the same macro trends. In a sense, a rising tide raises all boats. What we tried to highlight here, a little bit complicated, is not all surplus capital is created equally. And that depends on pension deficits, regulations around what's called Basel IV. And on the right, some banks have what they call structural hedge is in place with interest rate swaps. That reduces some of their interest rate sensitivity, but they should still benefit as and when UK interest rates rise again. Longer term, we see some really interesting opportunities around emerging markets. So we took this up from 12% of the trust up to 28% at the beginning of this year, playing obviously emerging Asia's better handling of COVID, and also two other aspects. One is there's a number of banks, other financials in Asia that are much more profitable than developed market peers. So we just show a comparison of profitability through return on assets versus Lloyd's as a sort of developed market comparator there. And also long-term structural growth drivers around the growth of financial services in emerging markets. We've reduced our exposure recently down to 17%, concerns about second and third waves, and also, benefiting, looking to switch into more developed markets, US and Europe, who've obviously dealt with COVID or with the rollout of vaccines more recently. So you're seeing the momentum move in markets in that direction. On fintech, it's an area of the sector that we like long term. This got up to about 16% of the trust last year. We've reduced it to around 12% recently on valuation grounds. And for us, this is mostly around payments. So our big holdings here are in PayPal and MasterCard. We own a little bit of Visa as well. Adyen we've recently sold. And this is really just benefiting from that shift from cash to card and from growth in e-commerce, which we see continuing. Insurance is our second largest weighting within the trust. So 2/3 of that is non-life. So when you're thinking of non-life, you're talking about companies like Direct Line. So this is commercial or personal lines, auto, household insurance, and the other third being in life assurance. So for non-life, what's traditionally a counter-cyclical defensive sector, it's not very economically sensitive because claims are driven by accidents and weather-related losses. Well, COVID was effectively a black swan event for the industry. And as a result, you've probably seen industry losses being at one of their highest in history. And as a result, it's led to a huge jump in insurance rates, as can be shown on the left-hand chart. Now, this is obviously different from car insurance, where you've seen different trends. Consequently, we see an interesting opportunity over the next 2, 3, 4 years, as due to these rate increases, that the outlook for the sector actually looks increasingly attractive. In the case of life assurance, we've played it through Asian Life, so holdings like AIA, Ping An, and a little bit of Prudential, where we continue to see good growth. Just quickly touching on valuations. Using price to book, we can use price to earnings, but on a price to book basis, valuations got down to the same level as the global financial crisis last year. We thought that was illogical considering the robust shape that the banking sector was in. They've now bounced back to between 1 and 1.1 times book, so we still see that as attractive in a post-GFC environment. And on the right-hand side, you can see non-life insurance valuations also have started to come back. Now, what we did here is, to try and put in context, the opportunity from a valuation perspective, we took 25 years of data from MSCI, and every single month, what was the price to book, and what was the subsequent 3-year return if you bought the sector in that month. And as you can see with a slightly busy chart, there's a very strong correlation between the lower the price to book you've paid than the higher return you've received. On the top right is obviously when valuations were higher, you've got pre-GFC, and on the left, you've got post-GFC. And if this correlation stands, it's saying you're going to get about a 30–35% return from buying global banks at this point over the next 3 years. Now that ranges on that chart between sort of 20 and 50%. Now with the tailwinds the sector's got from obviously growth surprising, concerns about inflation and higher interest rates, it could be that those returns you see them more quickly, or equally because that's been in a sort of post-GFC low rate environment that actually the risk is very much to the upside. Another way we looked at it, we looked at every single downturn since the early 1990s and looked at how the performance of financials have done from market lows. Every single time, financials have outperformed. Now, they're cyclical businesses, so you'd expect them to outperform in a recovery and underperform into a recession or a downturn. And if you look at the bottom right, the gold square box, you can see on average over 12 months, financials have outperformed global equity markets by about 22.5%. This time around so far, they've only outperformed by just over 4%. In a sense, the outperformance didn't start until November on the back of the news in the vaccine. So history suggests there's further outperformance, to go for. Entertaining slide, but obviously aware of obviously the strong performance of growth sectors such as technology and healthcare, less so recently. But you've seen this piece of elastic between so-called growth and value, energy and financials, is stretched significantly. And today you're looking at the weighting in so-called value sectors is down to levels very similar to the dot-com bubble in 2000. Consequently, with the tailwinds we've got currently in global markets and economies, we think you'll see that piece of elastic narrow, and that will result in obviously financials and other value sectors doing well over the next year or two. How's the portfolio positioned? So very much at this point of the cycle, we're overweight banks, so around 60% of the trust. We believe that's the right place to be. They're big beneficiaries of obviously the cyclical recovery. We're underweight some of the more defensive parts of the sector, such as insurance, fintech, so the payment companies I touched on. As this is a trust, we're allowed to use gearing. So currently it's around 9%, up from 3 or 4% this time last year. So it shows you we're constructive on the outlook. That gearing would never go higher than about 15%. That's the sort of maximum internal limit that's been set. And our recent reduction from emerging markets, we've upped our weighting in some of the European banks and other financials, developed Asia and elsewhere. But predominantly when you're buying this trust, you're getting exposure to, particularly the US, but also, Europe and emerging Asia are second and third biggest geographic weights. We're currently going through a corporate action, so-called C-share. So investment trusts can issue shares to the market in the ordinary course of business. You can go and buy them in the market. But because we're limited to how many shares we can issue, the board has announced a few weeks ago that we'll do what's called a C-share placing. Consequently, it's going to be a separate pool that will be launched in a week or so's time. And in 2 months after that, that C-shares then merge with the current ordinary shares to make one vehicle, and therefore a bigger, more liquid vehicle. We highlight some of the costs and some of the dates and some of the issues here, but happy to take questions afterwards. And there's, I believe there's more details on the AJ Bell website, which Roland can touch on later. And then just to quickly wrap up, very much an out of favor sector, very cheap. It's obviously a beneficiary of rotation into value and the reopening trade. And it's going to be throwing capital back to shareholders through dividends and buybacks. And you've got this potential upside from, interest rates leading to, increased earnings and therefore, share prices as and when that comes through. So I hope that's been helpful, but very happy to take some questions. Thank you very much.
Lovely, Nick. Thank you very much indeed. And Nick mentioned the offer is available through the AJ Bell UInvest platform. There is a section on there. If you go to the website to the shares and markets tab, and then there's an IPOs and new issues. And from there, you can see any current offers, download the fact sheet, the prospectus. If you want to invest, there's a way of doing that through the website. So that the shares and markets area, and then IPOs and new issues. Nick, thank you very much for the presentation. First question I've had about yield. You mentioned at the start, the initial target yield is 3%. What's the trust currently paying, and what's the outlook?
Yes, so the current yield is just shy of 3%. I think it's 2.8% today. Um, because of the dividend cuts, suspensions, etc., we had last year into this year, we've had to dip into our revenue reserves. So the trust is able to hold back, obviously, revenue reserves for a rainy day. So the board's used that to maintain the dividend at the current level. No decision has been made. It's unlikely to see a dividend increase, certainly for the next 12 months. And the board will have to obviously, look at that in due course and make a decision, what's the right level of payout, going forward from this level.
So if the banks or the financial sector lower their capital requirements and start giving that money back to shareholders, you would look to build that capital reserve back up again?
Yes, I mean, that's the aim. And obviously, we want to generate slightly more revenue than we're paying out, so we can build up those reserves again. And in theory, tomorrow we could move some of the portfolio and generate more income very quickly. What we're trying to do with the trust is get a balance between some of the more income or value characteristics of the sector versus the growth opportunities. And the combination of two, we hope, gives a good return over time. We can chase one over the other, but we're just trying to get that balance between the two. And if it's right to aim more for growth in the short run, for that to generate the extra total return, then that's what we'll do.
And had a question on portfolio turnover. Can you talk to, I think it was after you mentioned increasing and then reducing the emerging markets exposure, talk around the turnover in the trust?
Yes, so probably in a normal year, it's around 20-25%. I mean, last year it was extraordinary in so many ways, as we all know. And it was much higher than that. In a sense, the first, in the correction, we pulled back from the more cyclical elements of the portfolio banks, bought some more payment companies, more non-life stocks, and then did the reverse in September and October to benefit from the cyclical rally. So that's abnormal for us. Hopefully, we don't go through something like that every year. So 25% is a more normal level.
And a question about politics, Biden administration.
Yeah.
Is this a positive impact or a negative impact?
I suppose it's been a bit of both. There's concerns about, a Democrat administration, increased regulation, etc. Yellen, obviously coming in as a Treasury Secretary, is seen as a much more, pragmatic individual, unlike some of the other candidates that were put forward. And I suppose the one negative, obviously, and this affects all companies, is potentially higher corporate taxation coming through. But against that, the infrastructure bill that's been talked about, the stimulus, that's obviously very good news for recovery and growth, and what that means for inflation and therefore interest rates is actually very positive for the sector. So net, we think it's been a positive. It's a positive one.
A question mentioning interest rates. If interest rates go up, will people be able to afford their mortgages? Will that not counteract any benefits the banks get from increasing their margins?
Yeah, no, it's a good one. I mean, the history shows when we've had conversations with the bank's management teams, their argument is you need interest rates to get to closer to 4% before you start to see, significant number of people get into difficulty around paying on mortgages, or whether it's corporates that are over leveraged, etc. So it's very hard to see an environment where we get to 4% anytime soon. So we don't really see that as an issue at all.
Next question I've had has been on the new issue. What are the benefits for me as a shareholder or for a potential shareholder of a larger vehicle?
No, that's a very, very fair question. So obviously we want to get costs down on average for all shareholders. So that helps. Obviously improves liquidity, probably for, obviously those listing, it's only really an impact for sort of larger investors, institutional investors, etc. But that's probably the key two reasons. It's getting costs down and improving liquidity.
Okay, and then it's the final one for time. On the top 10 holdings, it looked like mostly larger institutions. And I thought you were also looking at smaller, medium-sized banks. And it might be talking about the US there in particular.
Yeah. We do. I suppose when we think about risk, you're thinking about individual banks and where their balance sheets. So if you're buying a JP Morgan, you're buying a global bank, or obviously predominantly US, but still global. So that risk is spread across a large, balance sheet. We're overweight US regional banks at the moment. Our largest bank in the UK that we own is One Savings Bank, or now called OSB Group. So we do have quite meaningful holdings in them. They just don't appear in the top 15. And we're always conscious of, where if we're buying a regional bank that's just based in, let's say, Texas or California, then we don't want to have too much material exposure. We want to spread that and diversify it, because this in a sense is a lower risk way of playing. You can go out and buy those individual banks, get, and do a lot better or do a lot worse. But this is just, the way we've structured it is to try and give a lower risk way of getting exposure to the sector, which gives you good returns, over time, without the volatility of picking individual stocks.
Lovely. Well, Nick, we're out of time. Thank you very much for joining us this evening.
Great. Thank you, Roland, and thank you everyone for listening.